Hello folks, this is Naeem Aslam, Chief Market Analyst at AvaTrade. In today's economic news, we had a large number of economic data. First of all, beginning with the Bank of England's monetary policy decision. The bank left the interest rate unchanged, which was primarily what the market was expecting. But the surprise from the bank was that the bank is curtailing its asset purchase program by August 11, and that amount is also quite a significant amount as well, upward of 400 millions. Now, of course, because of that, the market is anticipating that the Bank of England has come out of a gate with a bit more, not, we wouldn't say a hawkish, but not as dovish message as what the market was expecting. So what happened on back of that? We've seen a retracement for the UK's FTSE market. As you can see in the chart, the UK FTSE 100 is trading to the downside, and that is because equity traders were very much expecting more support from the Bank of England. It's not that the bank didn't provide its support. The bank did say that it is standing to provide more support if the market does need it, if the economy does need it. But I think right now the Bank of England finds more comfort on this particular stance that the coronavirus curve, the infection curve, is still somewhat flattened in a relative perspective where it was before. And in addition to that, the Bank of England is also feeling confident that the coronavirus situation is not as worse in the UK as it is over in the United States. But of course these can change because now the lockdown measures have a lot more eased off, and then we see a lot of people eating out, especially with the new initiative of 50% discount on eating out. That is because of the VAT reduction for in the restaurant area, in the restaurant sector, and other tourist related activities as well. And because of that, we are seeing a lot more surge in by the consumers spending more money. So of course that particular initiative by the government to stimulate or to save the restaurant industry or the hotel industry is working to a large extent. But of course, it is also going to increase the coronavirus infection rate, and that remains a major concern for the UK's economy. But moving away from the UK and going into the US, the data which matters the most, it is all about the initial jobless claim. The data will hit the terminal at 1:30 p.m. UK time, and at the same time we will also have the continuing claims data as well. Now, from the last few weeks, we understand that the initial jobless claims, they've been rising. Now, if today's number also confirms the same message, it means more weakness for the US equity market. However, the US equity market is very much in a Goldilocks situation. What do I mean by that? If the data continues to roll over like we've seen in the last 2 weeks, then that means more support from the monetary and from the fiscal policy front as well. So as long as that support keeps coming, equity traders are feeling comfortable with their risk or what they have on their books. But at the same time, there are also a group of investors who are ready to sell and punish the market because it has gone too far too quickly, and it doesn't relate with what the reality is, especially where the economy or the economic data is really indicating. Because if we are certain about something, that is that this is not a V-shaped recovery, or it is not the kind of a recovery what the policymakers they were anticipating. This recovery is going to take time because, as the Bank of England said, the pre-COVID GDP level for the UK's economy, the bank isn't anticipating by the end of 2021, not 2020. 2021. So that pretty much explains everything about this. That's all for today. I'll see you guys tomorrow.